If you have spent any time studying finance or pursuing a CFA, you know this formula. This is the Gordon growth model, the theoretical bedrock we use to value equities, relying on a clean, predictable relationship between dividends, required returns, and growth. But outside the textbook, the actual financial system does not operate cleanly. Markets are driven by erratic repo rates, widening TED spreads, and yield curves that can invert and flatten in a matter of months. These indicators are the real-world inputs for your valuation variables. A liquidity crunch in the repo market pushes the required return K higher, while a sharp contraction in broad money growth directly suppresses the nominal growth rate G. You can build a sophisticated discounted cash flow model, but if the macroeconomic liquidity transmission mechanism remains a black box, your valuation is completely disconnected from reality. The Federal Reserve controls this transmission mechanism. Yet the way most finance professionals are taught to interpret the Fed's actions is based on an economic architecture that no longer exists. Take the classic money multiplier. You were likely taught that M equals the multiplier M times the monetary base, assuming banks lend out a strict fraction of their deposits. That model is functionally obsolete. In March 2020, the United States Federal Reserve dropped the reserve requirement to exactly 0%. The mechanical rules that governed banking for a century have been disabled. Because banks do not lend out deposits, understanding true equity valuation requires unlearning the multiplier. We have to examine the actual mechanical clearing constraints of the modern banking system. To understand money creation, we examine dual-entry accounting ledgers. Here is JP Morgan alongside the Federal Reserve. When JP Morgan issues a $100 million loan, it lobs an asset and simultaneously credits the borrower's account with a new $100 million deposit liability. The bank did not move existing cash from a saver's account to the borrower's account. It generated the deposit out of thin air through a keystroke. Commercial banks are franchise creators of money. In the exact moment a loan contract is signed, a corresponding deposit is computationally born. It is entirely independent of any saver's cash. But that newly created money poses an immediate threat to the bank. When the borrower wires that $100 million to an account at a different bank, the deposit liability leaves JP Morgan. To settle that transaction, JP Morgan must transfer $100 million in central bank reserves to the receiving bank. Commercial banks can create deposits, but they cannot create central bank reserves. Those reserves are the exclusive currency of the interbank clearing system. If a bank creates loans faster than it holds reserves to clear outflows, the math breaks. It falls into immediate technical default. This is why banks fight for your deposits. They are not gathering deposits to fuel new loans. They are acquiring them because customer deposits are the cheapest mechanism to capture the vital reserves required to survive daily clearing operations. This chart tracks total U.S. bank reserves. Before 2008, reserves were kept intentionally scarce. After multiple rounds of quantitative easing, the system experienced a sharp vertical surge into the trillions. Because reserves are now ample and statutory requirements are zero, the Federal Reserve lost its traditional ability to tighten monetary policy by restricting the physical quantity of money. Instead, the central bank must throttle the economy through price. They established an interest rate corridor. The floor is the interest on reserve balances, or IORB. The ceiling is the discount window. The effective federal funds rate is engineered to float securely between them. By adjusting the IORB, the Fed pays commercial banks a high, risk-free yield simply to park their reserves. If a bank can earn a guaranteed 5% doing nothing, they have zero incentive to take on the risk of lending to the real economy at anything less. The Fed no longer drains the quantity of money to stop inflation. It essentially pays banks not to lend, severely crashing the velocity of money without shrinking the aggregate supply. When the yield curve inverts, a bank's maturity transformation model breaks. Depositors pull funds for short-term treasuries, draining the vital reserve pool. If quantitative tightening shrinks this pool further, the system fractures, like in September 2019, when overnight borrowing rates reached 10% instantly. Banks actually had reserves on hand. However, constrained by strict Basel III liquidity coverage ratios, they hoarded their remaining liquidity and refused to lend to one another. When this happens, we watch the TED spread. It measures the difference between the risk-free rate and the rate banks charge each other. When it widens aggressively, it signals that banks have completely lost trust in each other's solvency. The ultimate risk to equity markets is found in a clearing system fracture that occurs when bank reserves drop below their critical threshold. This creates a glaring paradox. The Federal Reserve is currently paying banks billions in interest through the IORB, while simultaneously losing money on its own massive bond portfolio. Its equity line is operating deep in negative territory. Any private corporation would be insolvent. But the central bank does not need tax revenue or bond yields to pay interest. It executes the payments by simply crediting commercial bank reserve accounts with new digital units. To reconcile the balance sheet, the Fed logs these losses under a unique, legally permissible accounting loophole called a deferred asset. As this imaginary asset grows, the negative equity magically rebalances to zero. A central bank issuing a fiat currency cannot go bankrupt. Its liabilities, physical currency and electronic reserves, do not require redemption in gold or any other asset. They are only redeemable in themselves. Yet the Fed cannot simply erase its holdings of U.S. Treasury bonds to clear the government's debt. Executing a direct, unbacked cancellation would destroy fiat credibility, sever the currency's anchor, and trigger immediate hyperinflation. Because direct default and outright debt cancellation are mathematically and politically impossible, sovereign governments deploy the only remaining mathematical endgame, financial repression. This chart illustrates the mechanism of financial repression. It requires utilizing prolonged quantitative easing and strict interest rate management to guarantee that inflation runs persistently higher than nominal interest rates. That red gap represents a guaranteed negative real yield. This negative real rate environment acts as an invisible tax. Without ever defaulting on a single bond payment, the government quietly dilutes the true purchasing power of its sovereign debt over decades. For the equity investor, this macroeconomic reality feeds directly back into the primary valuation framework. Broad monetary expansion artificially inflates nominal growth expectations, pushing up your G. Simultaneously, financial repression artificially suppresses the required rate of return, crushing your K. Macroeconomic plumbing is the invisible hand driving asset prices. Understanding these clearing mechanics, how reserves flow, how constraints bind, and how real yields are engineered, is the ultimate edge for surviving the next liquidity crisis.